For one then, the end of a rising market. An up bar on a narrow spread. Now the narrow spread is the most important part here, okay? That's very, very important. It has to be on a narrow spread, close on the middle or low, volume very high or stronger if ultra high. Weakness always appears on an up bar because professional selling has to sell into a surge of buying. The narrow spread indicates supply. Something has put a lid on the top of the market. Selling or lack of demand from professional money are the only two things that can do this. If the volume is ultra high, this will show a serious sign of weakness. This sign of weakness needs to have the following criteria. Okay, so pay attention to this because this is a very strong sign of weakness. The high or ultra high volume up bar, now an up bar, remember, is a price bar that closes higher than the bar behind it, must be into fresh new ground and will have a strong bull run in the background. That's important. It must be in a strong uptrend to be the end of a rising market. We don't want to see this where there's price action to the left, although occasionally you do see it. We really want to see it to be a strong sell signal right at the top. The price range or spread should be really narrow, and I'll explain in a minute with Philip why that is. The example we're going to show you is one that I've shown several times, and I'm going to show it today because it's such a good example. It's the US stock of JP Morgan Stanley. It's a very narrow range, and in fact the day in question that I'm going to show you, which was the 14th of October last year, it was within $1 for the range of the day. That's very, very tight. The spreads were usually much bigger on that stock, and it really was tight. Now the news will be good, as I'll show you, and that's going to be to mislead you. You will have the urge to buy this because the media, brokers, everyone will be recommending this as a strong buy, possibly even IBD, when in fact you should be not buying this stock. Indeed, you should be looking to sell it. Now, when we see this indicator, again, it's going to be difficult for you to spot it at the right edge initially, because your gut reaction, which is what causes most traders to lose money, will be to buy it because of everything you hear. But Tom, when we see the end of a rising market like that, you yourself, when you're a syndicate trader, if you wanted to distribute to the herd, you'd make sure there was a very good rumour out there, or you take advantage of good news, correct?
Oh yes, definitely. And don't forget, the end of a rising market is usually gapped up. Again, it's probably gapped up in the cash market with the specialists and the market makers gapping it up. The spread is narrow because they've gapped it up, and then as soon as the public rush in and start buying buying the stock, then of course because the constant supply is coming in from the professionals are unloading, then that caps the top end of that bar.
So basically what you're saying there, let me be clear, for every buy order from the herd who are rushing in, these professionals who've brought at much lower prices are just saying, hey, thanks very much, here, take it.
Yeah, take it.
At this high price.
Thank you very much for your cooperation.
If the market is gapped up and is approaching or at previous resistance levels, then this is an even stronger sign of strength. Now, Scott's one step ahead of the game here. He says, well, this must be around the news reports. Well done, Scott. You're very alert today. Scott has had his Weetabix and his coffees today because, look, this is the 14th of October. Indeed, you're correct. This is the earnings from JP Morgan. Now, this is great news, Tom. I mean, come on. They've just had their biggest quarter. I mean, the earnings are superb. The fundamental analysis is spot on.
Yeah.
This is a bullish stock. It's been going up. The banking sector will lead in the sector here.
Yes.
Now, come on, you're telling me that this is a sell.
Yeah.
But here we see this very, very high volume. Now, notice here, this is the actual chart on the day of the news release. If you look here, the date is the 14th of October. That's the same date that the news was released. Now, we notice the volume here. Now, look at this. I always call this Shaq O'Neal. And why do I say that? He's a famous basketball player, by the way, Philip. He's very famous. He's about 7'6", I think. But Tom used to say to me, well, from a VSA perspective, we are not looking at just normal volume. We're looking at relative volume. So I said, well, what do you mean by that, Tom? And I understand relative. And he said, well, relative to the previous bars around it. And this is why the human being is always better than the computer, because we have eyes and a brain. And computers have somewhat limited things that they can do. So, and I said, well, I still don't understand relative. He said, well, you live in Chicago. Imagine you were walking down, walking down Michigan Avenue, and an alien lands at 6 o'clock in the morning. There's no one else around. and he says, Gavin, how tall are you? And I said, I'm 6'2". And he said, I've got nothing to compare you to. So then I get Shaq O'Neal to stand next to me, and there's a friend of mine who's a jockey, lives in the same building. He's 4'6". Now, if I put him next to me and I'm 6'2", I'm going to be fairly tall. The jockey's going to be fairly short, and Shaq O'Neal's going to be this volume bar right here. Okay, so there's Gavin, there's the jockey, and there's Shaq O'Neal. Now, trust me, when you see Shaq O'Neal on a chart, as we're going to show you today, your trading antenna must go up and say, what the hell's going on? In Chicago, they said the same. What's going on? Well, I always now use that as a little trigger in my brain when I'm trading. As soon as I see ultra high volume on an up bar, or indeed a down bar, I say, what's going on? And from that, I then let the story unfold, because often you cannot take the trade immediately, as we're about to show you. But when you see good news, you wait after you've seen the high volume for the VSA setup to appear. And as we've seen, Philip, sometimes it's immediate within 3 bars. Sometimes it takes 25 to 30 bars. And today we're going to show people in this seminar where to look and where to see a clear, quick entry where you have to be patient. Most traders that are unsuccessful are not patient. Okay, so first of all, we look at this stock and we go back to the 30th of September 2008. Lesson number 1 here. Always look at the big picture on your chart. Put up at least 200 to 300 bars, or even more if you can, to see, okay, this is important, to see, do you have unusual volume in the past, or do you have an old top to the left that you're approaching? Now, here on this chart that we're looking at here, we see this old resistance level to the left. It was actually September 2008, and now we've gone up to it on an end of a rising market. And you know, when you see that on a chart, if you wanted to take an entry there, then you'd put your stop above the previous resistance level to the left here, because there is sometimes an occasion, it's happened to me before, where you see the end of a rising market and the very next bar there's an up thrust, because they're devious, which is why I always tell people you just need to be a little bit patient. So that's down to your decision, but this is where I like to trade this indicator, because it's far more low risk after you've seen it. So you wait for the market to roll over, almost like the top of a mushroom, okay? So, and we'll show you that in a second. We must see the downtrend forming, because I'm a trend trader, and we encourage you to trade in harmony with the trend of the price, because then you're swimming with the river and not trying to swim against it. If you swim against the river, you're not going to go very far. But if you jump in the river and you're swimming with it, you move much further. So always try and trade in harmony with price. Look for the market to make lower highs on the price bars. I'll show you that in a second. As the market falls, we've got to look for serious signs of weakness, like what we call no demand, which we'll talk to you about in a minute, or an up thrust. Either of these indicators, after you see the end of a rising market, are very high probability entries to the short side. So here is the very same stock from a much bigger view, and I want you to notice this actually was taken, the chart was taken yesterday, so it's right up until yesterday's chart or yesterday's close. We ignore the volume at the right there because it's from eSignal, and their end of day charts don't update for a day, so ignore that is not ultra high volume on the right there. But we do definitely have very, very high volume here on this down bar, okay, which happened a few weeks ago, and that can be weak, okay, and we'll talk about that later. But up here, which was about the early part of January, we see that there's the end of the rising market here. You can see the top of the signal, and you can see the mushrooming over of the chart here. See that? Tom, can you explain why these charts mushroom over like that?
Well, they mushroom over because once the initial bout of selling has taken place, in other words, with the high volume up bar, then they have to support the market slowly, and so they can distribute more on the next wave up. Right. And give it time, because they're distributing, it will give this mushroom shape. And very often you can see a lot of the up bars are on no demand in these weak markets. Mm-hmm. And that's why it mushrooms over. And funny enough, the bottom is the opposite. You get a saucer shape. Yeah,
I noticed that. It sort of comes up and then, yeah. Why is that?
Well, because you're just reflecting the buying in the saucer shape, and you're reflecting the selling in the mushrooming over.
Right, so basically when we see a chart that's got a mushroom top, we need to be looking for shorts. And in converse, if we see a chart that's almost got this saucer shape to it, which is the opposite,
Looks like
then,
buying.
and then we want to be looking to buy that as it comes out the other end of the saucer, so to the right-hand side of the saucer as you were looking for it. So here, we're looking for sell opportunities in these regions as we come down because we're in harmony with the trend. And notice, look, the trend, when we see a trend, you'll notice we get retracements. Why does the market retrace like that, Philip? Is that professional money supporting the price at certain levels because they can't just let the thing collapse?
It may be that, and it may just be that the index might be strong at that point. And I think Tom's expression is it all boats float with the rising tide?
Yeah, all boats rise with the rising tide in the harbour. And they also sink down in the tide going out in the harbour. And you'll find that that's why, look at the index. The parent index is so important.
Now we notice the end of a rising market's back here. Okay, and the market falls instantly. I mean, it did plummet fairly quickly because of this very high volume, and it's a gap up bar. But I want to talk about the spread quickly of this bar. It's almost like, Tom, we talked about we call volume spread analysis because you're looking at volume, price spread, and the closing price. And the spread here is the high and the low on that bar. It's within $1 for the day. Okay. In fact, you can see, in fact, I haven't got my cursor on that bar, but it's very, compared to all the other ranges or spreads, it's very narrow. The next bar, though, is a clue. It closes dead level with that bar. Absolutely dead level. Now, if there was professionals buying into that volume, surely it wouldn't close level, it would close higher. Just common sense. But it closes level, and then the next bar is a big down bar, and that's the one that really confuses people. It's so weak here that it takes out both of the lows of the previous days. And then we have a lovely little up thrust just here, just to really try and keep people locked in if they're panicking a bit. Don't worry, the market's trying to go up and it closes higher than the day before, and this bar here locks everybody into a panic situation, and suddenly either they're stopped out as the market falls, they're all confused because the news was good, and suddenly the market plummets away from them and they think, oh my goodness, what's happened? Now again, professionals will at some point bring the price back up, but you'll then be able to look very clearly to see if they're interested in higher prices, and this for me is a much better entry and a much better probability trade to the short side. I will be frank, and I put it, Philip, to you as well. You and I would probably short the end of a rising market without really thinking too much about it because we know the signal. And would you agree with that? Would you be or would you wait for confirmation on that?
I tend to probably be ultra cautious. Okay. So I may well wait.
And wait for the responses I'm about to show and then come back up. Okay.
Yes. Well, having said that, if it's complete fresh new high ground and there's nothing else to the left, then I would probably be very tempted.
Here, I'm just going to show you A and B because I want to talk quickly about these two bars here as you put your questions in. We notice that on bar A, the market tries to go up but collapses back on the low, closing lower than the previous day. Look at the volume. There is no professional interest to the upside on that bar. So that's your first indication, okay, your first warning that this is considerably weak. But this bar here is what we call no demand. We're going to talk about it next. And it's volume that's less than the previous two bars. It's an up bar, okay, closes higher than the bar behind it, and it's a very narrow range, okay. And because of the volume, it tells you again, as the price is trying to go up, professional money have withdrawn their interest. But what makes that bar and that bar such a great place to short is because that, in the background here, is still there. Professional money know it, and you now know it because you'll become VSA experts. So when you see that weakness in the background, now notice that weakness was back in October. We didn't try to come back up to approach this area until January. So you've got to be patient if you're a stock trader. It could take 2 or 3 months, and sometimes, yes, you say this looks great in hindsight, but it was there in foresight. And I went onto YouTube and put it up there. And all you're then looking for when you see that no demand bar, you wait for the next bar to close lower. Now, if you wanted to put an order in, you don't put an order in up here. You put a sell order below the no demand bar, because if you get a second no demand bar, it's not going to take you into the market. This bar here would have, whoops, this bar here would have, okay? So you've got no demand and you put the sell order just below it. So you're not actually buying at market, and this is an important point. You're actually waiting for the market to collapse onto your order. And at that point, you've got into the market at the right point. Do you agree with that?
Yes,
Philip?
I do.